Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. We would like to talk to you today about how your portfolio is doing. In general, as you know, we manage all of our clients' portfolios in a very similar fashion. While some people will have certain aspects of it adjusted in certain ways, custom to their needs, their tax bracket, their overall goals, their cash needs, et cetera, their risk tolerance, they still are organized in a very similar fashion. And so in general, we see the performance of our portfolios consistent over the range of different portfolios. I wanted to bring up a comment, Steve. As you probably have heard also, Warren Buffett has been famous for a quote where he says, well, only when the tide goes out do you discover who's swimming naked. And I just love that comment because when he makes that comment to his investors, he's reminding them that generally everyone can perform. Everyone's a hero when the market's going up. It's very, very hard to stumble or to do something wrong. But when the market is not going up and when there are differences in the various markets in terms of how they're performing, it really does come down to who is managing the portfolio in such a way where they're protecting the client, where they're protecting the portfolio from disaster, from really experiencing that whole downturn. And we see, once again, as we've seen many, many times before, our portfolios performing so much better than what we see in the market and also what we see happening in other people's portfolios who are not working with us.
Well, you know, we have the years of experience, and I have some of the wounds that have healed over from some of the mistakes we made years ago, and learning that when you ride that mountain up, especially with high price to earnings ratio stocks like Tesla, which is probably over 100, high flying stocks like that are priced that in a way that doesn't really reflect their true economic value, we know that they're set up for a fall. And it's actually a mutual fund now. I think it's called the ARC fund. It's down about 50% this year. And it's one of those thematic funds. I guess they concentrated on companies they felt were innovative. Well, now they're suffering for that because a lot of those companies they considered to be innovative are also wildly overpriced.
Well, and it's all about speculation.
Yeah, I still recall in the late 90s, a company called Cisco had a price to earnings ratio of about 140. And somebody calculated that they would have to increase earnings by 35% a year over 10 years to justify that price to earnings ratio and actually bring it down to earth and bring it down to something closer to maybe 35. And unfortunately for them to have that rate of growth in earnings, they would pretty much be the economy in 10 years if you compound those earnings over 10 years. So, you know, we've seen this before. And oh, by the way, you mentioned about our portfolios. All of our portfolios have been designed using the same underlying concept. And that's really the key here.
Well, there's a science. There's a real science behind investing. And even a lot of CFPs and people that have not been trained as CFAs or PhDs in investments don't really have that science nailed down. They don't fully understand it. And as we know, people that are in other business models often are limited and almost prohibited from using the science. But the science has been evolving over time and new tools have been coming out, and we use the science and stay very disciplined to the science, and it works. It's all about creating more efficient portfolios, greater return for less risk.
And sometimes we get criticized for being geeks.
Well, so the thing is that what we hear a lot of times in the industry, in trade magazines, on TV, and so forth, we hear this conversation happening over and over again. Is the 60-40 portfolio dead? And Steve and I just look at each other every time we hear that and say, what are they talking about? The 60-40 portfolio might have been a conversation I could imagine having 30, 40 years ago, but certainly not a conversation that somebody that is educated in the financial science should be having now. The 60-40 portfolio essentially says that you're going to invest 60% in stocks, and 40% in bonds. Usually it's what we see when folks come in from client service companies. They are moving their portfolio where they had supposedly people that really knew what they were doing. They come over with these 60-40 portfolios that are 60% not just in equity, but in large cap domestic stock only. Not small cap, not mid cap, not large, not international stock,
Not international.
none of that.
Yeah.
And then on the bond side, they come in with these corporate bond funds, which everyone knows how we feel about bond funds. And we're going to do a whole other section on bond funds and bonds. Yes. But they'll come in with just that. And we'll look at it, we'll say, well, what about the whole other piece of asset classes that can add extra value, that are negatively correlated or at least lowly correlated to stocks and bonds, that are publicly traded? That's very, very important to us. We don't want to go into the private arena in terms of investing. There's a whole group of asset classes out there. And this group sometimes is referred to as the alternative sector. We like to use the term enhancer because alternatives conjures up in our mind private investments and some things that might be a little bit unusual, while enhancer, the definition to us is that these are asset classes that enhance our portfolios because they have a low correlation to both stocks and bonds.
What they do is they improve the efficiency of our portfolios, in effect, improving the relationship between return and risk. And also, and that's what they are doing, reducing the downside capture. In other words, how much our portfolios drop in relation to the markets in general. And that's a key component here. By the way, we're going to be doing another video on why that's so important.
and so rather than the 60-40, we've been running portfolios for about 20 years now that are more like 33, 33, 33. And so this exact model, you may recall seeing this diagram on your quarterly statement. It probably looks something like this. This actually was lifted right off of a client's quarterly statement. We had some cash that we were holding for them because they have some cash purchases coming, but still it's effectively a 33, 33, 33 model. And so we were looking at this model, this standard model, and of course, there are some portfolios that are doing better, and there are some portfolios that are not doing as well as this model, although the differences are really minor. But we were looking at this model in comparison to what the US stock market has done as measured by the S&P 500. And we know that the S&P 500 is down year to date by 17%. And so we were concerned, how are our portfolios doing? And when we looked at our portfolios, this 33, 33, 33 is down more in the neighborhood of 7%. And I want
to mention that, by the way, a lot of bonds and bond funds are down about 10% this year.
Well, okay, so let's talk about the components, Steve, because that's really, really important. So when we talk about, well, I'm sorry, can we stay on the
sure?
Because we just these three big components, because we can then talk about the little ones, but the three big components, we have the stability assets, which really are our fixed income and our international, right? And that is something that concerns us, that bonds have really not performed well this year. In fact,
this is the worst, according to the Wall Street Journal, the worst year for bonds since 1842.
Yes, and it's definitely thrown a lot of people off their game. And so you can imagine if somebody is just in a 60-40 portfolio, there's no place to hide. They have stocks that are down and they have bonds that are down. But we do have this section of our portfolios that are in bonds. Of course, the difference, which we're not going to talk too much on this particular video about, but the difference is that we're in individual bonds that we're holding to maturity. We already know they're investment grade. We already know these are good quality bonds. They're kicking off a coupon We know that they're going to mature and we don't have to sell in this market. And so that is one
Yeah,
section that, although it might be pulling your portfolio down a little in terms of if we had to sell it today,
at least
we
on
don't,
paper.
yeah, we're not going to sell it today.
And I want to mention, because we use the safest bonds, we lose two areas of risk that do not exist for our bond portfolios. That's number one is default risk, and number two is credit downgrade risk. We don't have either in our portfolios. And in corporate bonds, you have both those risks. And I wouldn't be surprised to see those risks increase over the next few months if we end up coming into a recession. You're going to see both increase. You're going to see corporate bonds possibly drop even further. We don't have them though.
So that section is down by somewhere in the neighborhood of 9%. The whole thing is down around, I said 7 or 8% compared to the stock market, which is down
About half.
60%. So it's half. And how is that happening? We do have growth exposure, but even in our growth exposure, we don't have the same decline. It's not as bad. It's only down in the neighborhood of around 13% compared to 17%. And we can talk about that on the next slide. But the third group is the enhancer group. And that is the group that many people don't have that part in their portfolios. And we think it's so important. This part is down, depending on whose portfolio I've looked at, Steve, I think it's anywhere between like 1% and 3%.
Yeah,
So
that's
it's
about
really
right.
held everything up.
Yep. And one of the key components there that we'll talk about in probably the next slide that's actually held that piece of the portfolio up is a natural resources asset class, which is up an astounding, I think about 36% for the year. So
yeah, and we actually even did a video on the natural resources. It has been a great as asset class to have in the portfolio, but it's not the only one that's performing well. We have quite a few other enhancer asset classes in this group that are doing fairly well. They're doing, yes, they might be down. It's always an interesting thing when you tell people you're down, but be happy because you're not down as much. But that's really the name of the game is these asset classes are just not that far down. If they are down, they're down 3%, and 4% in that framework. So it's really working for us.
And there's no consolation, but what it does mean is when the recovery begins, you have a lot less ground to have to make up. And that is huge. And we're going to show that in another video, why that makes such a huge difference.
Right. So when we look at this growth component, and this is a Model 5, if you recognize Model 5, a lot of our clients are in Model 5. Some of folks are in a little bit more aggressive, and you chose that for a reason. We had a whole conversation with you when we went more aggressive with you. But this is kind of a good, healthy portfolio. And what we did was we just outlined the growth items because we wanted to show you that it's not just large cap, you have mid cap, small cap, which are not down as much as large cap.
No, it's not.
Right? And international as well is not down as much either. No. And then,
by the way, international, we believe, is really undervalued right now. I think the price to earnings ratio average for the MSCI index, which is an international index, is about 10, which is pretty reasonable pricing. So we could see rotation back to international outperforming domestic in the next few years, potentially.
Which is what we saw from 2000 to 2010. Yep. International outperformed domestic, which is why anybody that was just in a US domestic portfolio, if they just stayed there and rode the roller coaster up and down in 2001 and then up and down in 2008 and just stayed there, they would have been nominally whole at the end of that period. But anybody that had some international and some small cap and other items in their portfolio, they saw growth. And
when we go down these lists, I just want to mention a couple things here. The alternative lending is actually up for the year, even though it's a fixed income like investment. It's not acting like bonds are acting or the stock market. It's up about 3% for the year. The natural resources up is about 35, as I said. Private equity is actually up for the year. It's up for about 4% for the year. And the reinsurance bonds are basically flat for the year, up slightly. So we have 3 or 4 asset classes that are significantly outperforming most of the other asset classes here, significantly improving up diversification here. And by the way, the alternative assets are only down about 3% or so, as Laura said.
Because remember, there's 2 different definitions of diversification. A lot of people think of diversification as not putting all your eggs in one basket, and that's great. We absolutely agree with that concept, but it's even more than that. It's about finding asset classes that have different sources of risk, so that when the market all of a sudden starts acting silly, as it's been behaving lately, we know that these other asset classes are not going to be impacted by that same problem. So they've all been doing great. And then, so when we move down into the whole growth category, and Steve, if you could just click one more time, just on large cap. This piece, remember we said a 60-40 portfolio would have 60% in large cap. This portfolio has 12% in large cap.
Right.
So there's a big difference between what you would see in a standard 60-40 portfolio and what we're actually doing.
Yep.
There's even further difference to what we're doing, even with the large cap, and that it has to do with that next slide, Steve, that you found from the Wall Street Journal.
Yeah.
And being academic writers, I want to be very, very clear. We know that we're not supposed to plagiarize or lift things. This came straight from the Wall Street Journal. We want to thank Peter Santilli very much for this diagram. I want to give him full credit because we did not create this diagram, but it was just so powerful when we saw it. Because when we looked at it, we said, well, gee, if we know that year to date, the S&P 500 is down by 17%, what's causing that? And what this shows us is that, what is that, 6 or 8 of, am I counting right? Large cap companies, these mega companies are driving the entire decline.
The decline, yep.
And so when you look at the S&P 500, you know that these are the companies, Microsoft and Apple and Meta platforms and Tesla, they're the ones that are moving the needle.
And they were the ones that were most overvalued, by the way, had some of the highest price to earnings ratios. I know Tesla was about 100 last year, price to earnings ratio, I believe. And NVIDIA was over 100, I think, or so. And NVIDIA's down to about 40 or 45 now because it declined so much.
Right. So Steve is talking about a valuation called the price earnings ratio, which really you would expect maybe a good price earnings ratio not to be too much more than 20, for example.
Yeah. Yes.
So 100 was crazy. 45 is still way overvalued. So even for people that are thinking, well, this has gone down and it's going to have a quick bounce, it could, but we're not so certain because the valuation is still not appropriate for the price.
In my experience, I've seen stocks with high price earnings ratios when reality starts to hit the potential future for that company, their stock price languishes for years, potentially years.
Well, we were talking earlier today in 2001 when a lot of those tech stocks went down. It took up until 2015 for the NASDAQ to recuperate from that. And that's why we've been very, very hesitant. Anytime we get a client that comes in the office and starts talking about owning all this technology stock.
Yeah.
In fact, in the past year or so, I can't even say how many times I've just looked someone straight in the eye and said, it feels like 1999. It feels like 1999. I just don't like how this feels. Or
you might just want to mention what we do in this area to sort of guard against this. So we do something important here, right?
Mm-hmm. Yeah. So it's the whole aspect of we still want exposure to these 500 companies, but maybe we don't want overexposure to these top
Right.
firms. So instead, what we use is they're actually ETFs, but they select the funds in a different way. They weight them in a different way. There's
Yep.
the regular S&P 500 is weighted in a way that they call cap weighted. And cap weighted means that however the company is capitalized, whatever proportion of that company is there. Yeah, it might, you actually want to go, you want to go 2 slides ahead and show them?
Yeah, I was going to say, that's what I was going to look at. Yep. This is a perfect example.
Right. This is just an example of 4 companies. And if you were going to create an index with these 4 companies, the left-hand side is showing you that you would have 58% of your index, of your overall holding, would be the company A, and only 12% of how much you would hold in company C, of the portfolio would be in company C. That would be a market-weighted portfolio or index, if you will. The index that we tend to work with is something called equal weighted, where it basically almost ignores the actual number of shares or price of the stock and just says, you're part of the S&P 500. We're going to recognize you in an equal proration as every other company within the S&P 500. And the equal weighted has performed much better than the actual market weighted index this year. I think it's down 17% versus 13%, somewhere around that neighborhood, or 14%.
Yeah, I think it was even less, but
okay, it could have been less. Okay.
And the reason is, it's in effect, it's sort of skimming off a sector of the market and leaning more toward the sector of the market that isn't as overvalued.
And there's another weighting also, which we don't have a diagram here on.
Revenue.
And that is the revenue weighted. And that's very interesting. We were looking at the size of these different ETFs and indexes to see, where people are putting their money. And of course, most people are in SPY, which is the market weighted.
Mm-hmm.
There are some people who have been very smart and have discovered the equal weighted, but it seems like the revenue weighted has not been as well discovered. And that's interesting also, because it's looking at the companies that are generating the most revenue.
Yep.
And therefore, if they're generating a high revenue, they should be better performing stocks. There's a reason for them to command higher valuations.
And it's more realistic from the standpoint that you're sort of weighting that index based on economic footprint, rather than what the market says a company's worth, which in many times is artificial. And we're seeing that now with those 6 or 8 companies we showed in a previous slide, that their value really was artificial.
So, just in general, we are very satisfied with how the portfolios are doing. I know for a lot of you, you may, feel like, disappointed that you're down, but in this current environment, we believe that the idea is to just not go down as much so that you can recuperate more quickly. We know where all of your cash is coming from. If you have any spending needs, we've discussed this with you, and we know we're getting dividends, we're getting coupons, we're getting bonds matured. We're not selling into this decline. And we feel pretty good about the fact that we've been able to minimize this. This is where we really feel that we earn our earnings, because this is what the value that we bring is, making sure that you are not exposed to as much risk as you might be exposed to otherwise. This is what all financial advisors should be doing. And
that's correct.
I'm not sure, I'm not going to say any more about that.
By the way, this is one of the best examples of the effective diversification I've seen in several years. And
yeah, we saw it in 2002. We saw it in 2008. We even saw it a little in 2020. And it's not only just about the actual time period where it declines, it also is about how you get out of the decline. So
Right.
once we start
How you
climbing out
recover.
of this, how the way you're set up is to recuperate faster
That's right.
than you would normally recuperate if you were just in the 60-40 archaic model.
The recovery should be set less arduous. That's for sure, when things do recover.
So again, I don't know if do you want to say anything about the rebalancing process, Steve?
Yeah, and we do rebalance. We do rebalance based on triggers, and we don't show the percentages here, but typically we rebalance based on a 20% threshold. So if you have 10% in a particular asset class and it goes up to 12%, that's typically a trigger to rebalance and push it back down below the 12% threshold. Or if it drops from 10% to 8% of your portfolio, that's a trigger to push it back up above that threshold. We are being rather cautious right now about rebalancing because in many cases it would mean really selling some of the natural resources asset class. And though we're not trying to time the market and we won't do that, we are being cautious because natural resources are continuing to outperform, and we don't want to lose any of that outperformance right now. In particular, while we are experiencing this high inflation, which we really know is driving that return with natural resources. So.
Well, that's where there's a little bit of art to the science, and we try to use the framework, but
Yep.
yeah, okay. So again, as always, we appreciate you listening to our video, and we're here to answer any questions that you have. So please feel free to call us. We have tried to reach out to almost all of our clients. We've left messages on your phone if we haven't spoken to you. I know some of you feel that this is why we've hired you, so we don't need to worry. We're doing the worrying for you, and you're right.
Yes.
But we want you to know what we're doing, because the more you understand it, hopefully the more comfortable you feel.
That's correct.